Hi, welcome to the Real Investment Show podcast. I'm your host, Lance Roberts. Our special day returning guest today. We're so excited because we just absolutely love Pedro da Costa. Of course, he is working over at the Economic Policy Institute and is the host of the new State of Working in America podcast. And I certainly encourage you to watch the podcast. It's actually very good. I've watched it a few times myself. Pedro, welcome to the show this morning. How are you?
I'm great. Thanks so much for having me, Lance.
So let's just dive in with both feet. And I think it's interesting because, we have a little bit of different views on things about the economy and about markets and things that like this. That's a good thing, right? But what makes a good market is not always everybody having the same opinion. And I thought this would be a great opportunity to talk to you a little bit. I've written an article about this just recently. President Trump recently coming out stating this is the greatest economy ever. Yet we look at CEO confidence. It's, near some of the lowest levels on record. And, we've got the Federal Reserve now cutting rates and launching back into QE. There seems to be a bit of discrepancy between the greatest economy ever and what's happening in the background. I just want to kind of get some of your thoughts about it.
Well, first of all, the real Donald Trump said it in all caps. So therefore, it must be true. Let's start there.
Okay.
So now back to Earth One, as they say. No, the economy is not the greatest ever. In fact, I think what we're witnessing is a long but weak recovery that is now appearing to peter out. It's not petering out as quickly as the market feared. I think the recession fears were a little bit premature. There wasn't any evidence that the U.S. was about to go into a slump, and we're not there yet, as you saw from the most recent GDP reading. But you are seeing a consistent slowdown in hiring, despite the sort of better than expected recent payroll numbers weren't really that great. They were just better than expected.
Right.
We're still seeing a slowdown in the pace of hiring from last year. Importantly, we're seeing a slowdown in the very important indicator called wage growth, which is what people actually see in their pockets. And how most people perceive the economy. So no, it's not the best economy ever.
Well, so there's a couple of interesting things about this. And, from an investment standpoint, investors are very excited because markets are ratcheting new all-time highs. In fact, I just published an article this morning talking about some of the idea that investors are basically all into the markets. You look at cash levels of investors, they're at near record lows. Mutual fund cash levels are near record lows. Sentiment is extremely bullish around the financial markets, but that really doesn't have much to do with the economy as much as it does to the fact that the Federal Reserve is back to cutting rates, 3 rate cuts this year so far, and back to doing QE. And yes, I know the Fed says it's not really QE because it's bills, but the market sees it as QE. So if it looks like a duck and quacks like a duck, it's probably QE, right?
Well, I actually agree with the Fed that it's not really QE. And I know I'm not with most of the market on this.
See, I told you we didn't agree.
But I actually think that the Fed is trying to be technical about how it manages rates. What the Fed did was it underestimated how big the balance sheet needs to be post-crisis for the rate to actually function in the way that they want it to function. And so they're trying to do these interventions. I don't think they're as sort of diabolical and kind of backdoor QE. If they wanted to do QE, they would want to get the bang for their bucks. They would want to call it QE. So, you know what I mean? The Fed wouldn't want to do a massive policy measure that is based in part on the way it communicates that measure and then hide it from the public. It doesn't actually make sense.
No, that makes complete sense. But there's something going on here. I mean, look, this whole thing with the Fed coming in and buying over $200 billion worth of Treasury bills at this point. You don't just come and do that. The initial impact was there was a concern about having enough excess reserves, and the initial statement was, well, it was because of corporate tax payments, right? So there's not enough reserves in the system, and so we need to add some reserves to meet these corporate tax payments. But look, corporations knew their tax payments were coming due. The banks knew these tax payments were coming due. So that story never really carried a lot of water. But even if it was the story, tax payments have been made, right? So we should be back to normal. But yet we're still seeing this continued need for excess reserves and this continued need for the Fed to step in by providing this repo funding. So, when I'm looking at this, that certainly smacks that there is something, maybe not necessarily broken, but there's something at risk within the system.
So I'm with you there. We definitely agree there. And I definitely look at this with some skepticism and suspicion. And I'm looking for what the Fed is actually trying to accomplish. I think part of the story that we haven't touched on is the fact that post-crisis, because of regulatory concerns and issues, actually elevated capital requirements and things, just the sheer demand for treasuries, and also the general post-recession credit aversion that happened globally. I think there's a general surge in the demand for treasuries that the Fed underestimated, and that affects the way its rate structure is taking place. But to your earlier point about the disconnect between stocks and the real economy, I think this is a really, this juncture in time is a really important example of that, because, as you said, you see markets hitting record highs, but it's mostly on these sugar high headlines of like, will they or won't they strike a trade deal with China? When in fact there's a lot of malaise happening in the system. But for day traders that really doesn't matter. If you're a long-term investor, it matters a lot, and you're probably worried about what's happening to your 401k and whether the recent gains will be sustained.
Right. Well, and look, I think when we talk about individuals, and and let's kind of shift back to how we kind of started this initial conversation, right? Greatest economy ever, in the history of the world. The economy's going to be growing at about 2% on average since the turn of the century. It's one of the lowest growth rates of economic growth throughout history on an average basis. I mean, it's even lower than where it was back during the Depression, which kind of tells you a little bit about where we are. We're pushing $24 trillion in debt. We're running a $1 trillion deficit in the midst of an expansion that certainly doesn't really smack of this idea that there's this really strong, booming, economic environment underneath the surface. And specifically when it comes to consumers, there's many studies out about an inability to meet a $500 payment. 401k plans have less than a year's worth of salary in them, if they even have one. So there's, the financial strata of the country certainly doesn't suggest that the economy is really as strong and beneficial across the spectrum as we're kind of led to believe by headlines.
Absolutely not. And let me introduce another factor, which is something that EPI focuses a ton of, which is inequality, right? One thing GDP doesn't tell you is, who's benefiting from whatever meager growth we're getting. And if you actually dig into the numbers, then inequality has actually surged. It dipped for a little bit as the sort of financial gains pre-crisis got wiped away, but it quickly returned to its. You talked about the Great Depression. That's certainly one indicator that I recall. That was the first indicator pre-crisis, pre-Great Recession that actually was compared to the Great Depression. Around 2006, I remember the Reuters headline that said, inequality now at levels not seen since the Great Depression. Right. And I remember thinking, what could possibly go wrong? A year later, we were in one. So I think that's a huge factor, and that's a factor that's going to drive the electoral discussion, because it's, in a way, Donald Trump is stuck in the same hole that Hillary Clinton struggled with, which was trying to sell a subpar economy to a public that knows the economy is subpar. So when he was in the opposition, it was easy for him to say the economy is not working for people, and people know it's not. But guess what? He hasn't done that much. If anything, he's done things that have made it worse. And so he's in a similar position as a campaigner next year, trying to say it's the greatest economy ever when people know in their pocketbook and at the kitchen table, if you will, that it's not.
Yeah, and I think that's an important point, which is, one of the things that we've seen here, and again, it's interesting when you take a look, there's, a lot of statements that are thrown out to take a look at debt to DPI, right? Disposable personal income, take a look at the debt ratio, and it's fallen, right? It's the lowest it's been in a decade. And so everybody points to us, they see how good it is, but the problem is that those numbers are heavily skewed by the top 5 and 10% of income earners. So once you start stripping out kind of the layer, and we've talked about this in the past in a variety of measures, and we know that once you get below the 90% level of people in the economy, they're having trouble making ends meet. Income growth has grown, absolutely, but it's about the same level as it was in 1998. Of course, real inflation, what people really have to deal with, housing costs, college costs, insurance costs, healthcare costs, have all risen markedly over the last decade because of a variety of measures. But the real impact to America is that they're really kind of struggling to make ends meet, and I do think that's an important point here. Inequality is partly fueled by what we're watching through Federal Reserve policy, right? It's incented corporations to take actions. Zero interest rate policies incented corporations to take on a lot of debt, to do a lot of things that have benefited the wealthy, quote unquote, corporate executives, et cetera. But that really hasn't trickled down to the population itself.
No, actually, I disagree with you drastically there.
Oh, great. Okay.
And so the reason I disagree is I actually think that on balance, easy Fed policy is actually very progressive, and you need easy Fed policy in order to have full employment, and you need full employment in order to get people at the bottom engaged in the economy, people who are not participating in the labor market back into the labor market, into the labor force. And so I think that the forces that are behind inequality have very little to do with monetary policy, and they involve tax policy. They involve, not just Trump's tax cuts, but years of regressive tax cuts that bowed to the god of trickle-down economics that is definitely a false idol. Mm-hmm. And years of policies that hampered unionization, which hampered workers' bargaining power and our ability to ask for higher wages. And so I think Fed policy plays a marginal role as far as inequality, because all the benefits, sure, you see a boom in financial assets and that benefits the rich, but you also see a boom in real assets like housing, and you see, lowering rates for across the economy. So I would take issue with the notion that easy Fed policy is, by definition, inequality inducing.
Well, what I mean by that in particular, though, is that what low interest rates have led to is the usage of debt, right? So we've seen a lot of people, not just corporate debt, but corporate debt, household debt. Look at real estate prices in California where you live. I mean, you've got very, very high real estate prices, and that's been a function of low interest rates, which has promulgated people to take on debt to buy houses, driving. It's a supply-demand game, right? So which has driven up housing prices, has made housing unaffordable for a lot of individuals. Millennials are coming up. They can't afford to buy houses. Not only can they not qualify for them, but they don't make enough money to earn it because, right, we haven't seen the wage growth. We talked about that a minute ago. And then we have to talk about stock buybacks. Under the Reagan administration, they reversed the rule. Stock buybacks used to be illegal. Clinton tried to fix the problem of executive compensation by limiting CEO executive pay to $1 million. Then, of course, they switched everything to stock-based compensation, which has really been a massive driver of some of the wealth discrimination between C-suite executives and the working class American.
Enormous. And that's a huge point. So, again, I would focus more on the large-scale, long-term factors affecting wealth inequality, both at the top and the bottom. So before I was talking about unions and the lack of wage growth at the bottom, you mentioned CEO pay. EPI puts out an annual report that measures the ratio between average CEO pay at the top, Fortune 500 companies and workers at those firms. And the ratio it peaked at, it started in the 60s and 70s, it was something like 30 to 40. Meaning the CEO made 40 times the average worker.
Right.
And now it's something like 300. I think the last year was 278. And that trickles down not to the worker, of course, but it does trickle down to the entire C-suite level. So it's not just the CEO that makes a ton, it's the CFO, it's all the C-level executives. And that really skews pay at the very top in a way that is kind of immeasurable. Let me give you an example of something I learned at EPI that's very geeky but very important. Because measuring wealth, because if you try to measure wealth for wealthier individuals, you could actually get into a level of specificity that it might tell you who the person is. The way the BLS collects data, they use something called top coding, where they make certain assumptions about income levels above a certain threshold, and it's a pretty low threshold. And that means that you actually don't even capture the really, really sharp income gains by billionaires and hedge funds and private equity. That's not even in the data because it's masked by assumptions that understate it. Right. So it's really a massive problem that has, a lot of dimensions to it. But I don't think Fed policy is one of the main ones. I think taxation is an issue. I think the lack of supportive fiscal policies that redistribute wealth when the economy is growing are an issue. think I would focus on those, but we can talk about rates.
Yeah, clearly, we're seeing the problem of this wealth inequality that has occurred. Look, I'm a huge fan of capitalism. I've built multiple businesses throughout my life. I've bought and sold businesses. I fully embrace and endorse the ability of capitalism to build wealth. You do too. I mean, you're starting, you're running your own podcast, or you're wanting to do other things, right? That's capitalism, where individuals have the ability to go out, take on risk, take a chance at doing something, and they may succeed, they may fail, but that's the beauty about capitalism. But one of the things that has derived from that is crony capitalism, which is a function of these corporate kind of CEO pay packages and stock buybacks. And these things are easy to fix. Stock buybacks were illegal for 50 years because they are a form of stock price manipulation. They should be illegal again. I am all for that. But there's a lot of demand to keep that in place to support this idea, right? And it's corporations that drive a lot of the donations to politicians. So there's a lot of kind of incestuous relationships there. So these things are very, very difficult to change. And because of that, though, it's not surprising that you see candidates running for president now that are talking about socialism and are talking about redistribution of wealth and policies that lead to that, which are appealing to people that feel they've been left out.
Absolutely. And I think you make hugely important points. And I think our whole political agenda is being driven by inequality in a way that was not acknowledged before the financial crisis. Mm-hmm. And I think that concentration of wealth isn't just an economic factor. It spills over into the political realm, as you mentioned, and it becomes self-perpetuating in a crony capitalist fashion, right? Because policies, one of the most frustrating things about working at EPI actually is to see just how easy many of the policy solutions are. We know what they are. It's a question of getting politicians who, have the guts and I guess the lack of strings attached to be able to implement them. So, right. So we can put restrictions on CEO pay, not in a way that kind of stifles inventiveness or drive or capitalism, but in a way that stifles or prevents crony capitalism, in the way that prevents CEOs from stacking their boards with people who will then set their pay in a way that is completely incestuous, as you mentioned. So right. There are fairly easy solutions, and you kind of need bold people to implement.
It's very important that we don't destroy the golden goose, right, that has driven the beauty of America long term. And look, America is the richest country by far of any country in the world because of what capitalism built. And I certainly want to make sure that we don't destroy that ability for the next generation to enjoy these things, right? I mean, look, we've got, millennials that are coming up. They're creating great companies, right? Maybe not WeWork, but, we've got a lot of great companies that are being innovated by young millennials. And we certainly don't want to, as you said, cap innovation, cap the ability for these people to have access to capital and to grow their businesses. Small business owners like myself, we don't have the ability. Our pay as owners of small businesses is based upon the revenue that we generate and the profit margin that we have, and our employees get paid first before we get paid. And that's just the function of small business. This idea of crony capitalism, it only exists on Wall Street, because outside of Wall Street, the ability to create these excess pay models simply does not exist.
I wouldn't say it's just on Wall Street. There's other corporate sectors where it happens, and I think the Trump administration shows that you could have crony capitalism in coal. I mean, you pick the industry, and he's got his man. So I think it could happen anywhere. But Wall Street is a generally fertile ground for it, because I guess there aren't that many hard assets. Money is fungible, and so finance becomes it's more easily turned into a Ponzi game than other industries.
And maybe that's the right term for it. Absolutely. Well, look, let's shift gears here. Let's kind of go back to where we started with this. So, we're talking about the greatest economy in the world, and this is, the idea, but yet, we've kind of touched on these topics. When we actually look at labor force participation rate, there's 90 million people sitting outside the labor force. When you take a look at the number of individuals that are participating at higher levels in the economy, that's at some of the lower levels that we've seen in several generations. Yeah, what concerns me is the fact that we continue this idea of fostering kind of hope through the idea of just, hey, more debt, more, we keep suspending debt ceilings, we keep increasing debt, we keep increasing our deficit. Doesn't seem to be any real restriction by any of our government officials across the board to really try to focus on creating true organic economic growth. And what I mean by that is specifically, and here's the question, negative interest rates, 17 trillion around the world, and it has done nothing but destroy the European banking system, has not helped growth, has not helped equality. And Christine Lagarde, formerly the head of the IMF, now the new head of the ECB, says people should just be grateful to have a job. They don't really need savings.
I actually think that the ECB has prevented a significant further downturn. I mean, let's remember where we were in Europe in 2012, right?
Right.
For all his faults, he's a former Goldman Sachs banker himself. But for all his faults, Mario Draghi did manage to somehow hold that really wobbly thing together. And I think that the ECB's firepower, however weak it was seen to be, it did kind of hold the thing together. So I wouldn't underestimate the power of monetary policy in that context. But I think, more broadly to your point, we do have a lot of debt out there. My concern is less with the deficit in and of itself in the United States context. Europe is different because Europe has a currency union, and so the deficits there don't operate in the countries don't have the same leeway to run, individual country deficits in the way that we do. Mm-hmm. The United States the dollar is the world's reserve currency. We have ample fiscal room. The problem is, how do we use it? So, Trump inherits a fairly large deficit that was, of course, incurred in part because of the large wall that had to be climbed to dig out of the Great Recession. But then instead of using the growth that we're getting, or even to use the stimulus in some major productive way, he spent it on a tax cut that just, kind of supercharged the process of buybacks and the wealth accumulation that you were just discussing. And so that leaves us open to the possibility that politicians will be reluctant to spend money when the next recession comes and we actually need it. That's the thing I worry about.
That's kind of my point, though, right? You're running $1 trillion deficit in an expansion. So what are you going to do when the recession comes? And that's also really back to the Fed. Is my big concern here is that, you were at 2% on the Fed funds rate, 2.25%. And going into the last recession in 2008, we were near 5% on Fed funds rate. So you already had very limited ability to lower rates to battle a recession, and you've already lowered rates 3 times this year. So you've eliminated a lot of your firepower from that. Whether or not you want to call it QE, you're still putting more excess reserves on the books of the Federal Reserve. We're back up over $4 trillion on the balance sheet, again, using ammunition that you've got to fight a recession with. And to your point, you don't launch tax cuts in an expansion. You launch tax cuts coming out of a recession like Reagan did, where you get that help, that boost from tax cuts to help, rebuild an economy coming out of a recession. So we've used all the stimulus that we have in an expansion, which leaves you very little ammo to fight the next recession, unless you believe we're never going to have a recession again.
No, I agree that I wouldn't say we've used it all, but we've used fiscal stimulus, you should always do a fiscal stimulus in a recession, no matter what the debt level is, because you literally are getting paid to borrow because your interest rate structure is going to shift that way, right?
Right.
So there's no scenario under which it's not a good idea to borrow if you're in a recession. That's the way to get out. That's pretty much Keynesian economics 101, and even some libertarian economists happen to agree with that when push comes to shove. But I would say on the monetary side, it's really interesting what you said, because I think the market is already pricing that in a sense, because if you just look at it, Fed policy is just not as relevant to market trading as it used to be. It's still a factor, but when you look at it, the trade war has almost superseded it. I think because people know that you're not really going to get that much bang for your buck from an eventual, even from the current stimulus run, much less from any attempt to fight a recession. So people are already looking beyond the Fed to other factors.
Right. But I do want to correct you about one thing about Keynes, which is Keynes was a big advocate of doing fiscal spending in a recession, but you're supposed to be in a surplus before you go into the recession. And that was Keynes' point, is that you do it in the recession, but you rebuild the surplus when you're back in an expansion. We're in a $1 trillion deficit.
I'm going to have to reread my general theory. I'm pretty sure he would still advocate a stimulus even without a surplus, because that's, I'm pretty sure we didn't have the surplus going into the Depression.
Yeah,
so.
No. But my point is that, you know, his policy is that, yes, you do spend deficits in a recession to help stem the recession and help create a recovery. But once you recover, you're supposed to rebuild your surplus. We have continued to deficit spend without end since Reagan was in office. We've never rebuilt that surplus to any great degree. And so, and my point is that you're already running a $1 trillion deficit, which really is going to be problematic when you hit the next recession, because now you're going to be talking about a $2 or $3 trillion deficit. And let's not even talk about the problem of the pension funds, because when you get another 30 or 40% drawdown in the markets, your pension funds are going to blow up, and that's another $6 trillion hole that's got to be filled, and the government has got to do that by trying to bail out pensions. So now you're talking roughly maybe a potential of a $6 to $8 trillion deficit, and that's not a good thing.
Well, basically, deficits are a problem if rates skyrocket. They're manageable if rates are low. Mm-hmm. $8 trillion wouldn't be great. You know, we could talk about how far the deficit can go before it becomes a problem. Japan suggests that we can go a lot higher. My worry is that politically, politicians, the same politicians that were totally okay with the Trump tax cuts blowing out the deficit, under potentially a Democratic administration, are going to say, oh, my goodness, we have a huge deficit. We shouldn't spend our way out of a recession. And that would be the wrong thing to do, and that would lead to a prolonged depression.
Well, look, we saw the same thing under the Obama administration. Republicans were running around with their hair on fire, talking. And this is one thing that, you know, let me be upfront. I'm a fiscal conservative. I believe that we should run surpluses in the government, that we shouldn't run big debts. We should, you know, meet our obligations, blah, blah, blah. You know, and conservatives, quote unquote, and I hold up the quote fingers for that, they were running around during the previous administration under Obama, you know, crowing about the massive deficit, the fact he's running a $1 trillion deficit, and he doubled the national debt. And then when Trump gets elected, then you don't hear a word. And apparently it's completely okay to run deficits of $1 trillion and increase our national debt to $24 trillion. You know, I don't deal well with hypocrisy. My problem is that we have now limited our ability to fend off the next recession when it occurs. And I don't think it's a question of if. I think it's just a function of when. And by having limited tools available, it's going to potentially make that recession much worse than it should have been.
That's right. And I think to your point about how there was hesitancy under the Obama administration, even at the depth of the recession, the other thing that we haven't done is actually developed a fiscal plan with which we will react to the recession. So I think that it would be a lot easier to allocate, say, $1 trillion or $2 trillion if you had a concrete plan. In the same way that the Fed has a certain reaction function, we kind of expect it to behave in certain ways. You know, we know a recession's coming, and yet we go into it totally unprepared. And we think that Congress is going to come together and decide on the best thing to do on a frantic, like, 11th hour discussion. I think that's what I find really frustrating as a policy person is that there's no prudent planning for fiscal policy when it comes to recession. And I hope Congress addresses that at some point. Well, I think it's even the Fed's role to tell Congress that it needs a plan, because the Fed should be telling Congress that, look, we can't do this on our own.
True.
Otherwise, it'll be their problem.
Hey, Pedro, thanks. That's really great information, and I absolutely agree with you. And look, make sure and follow Pedro's podcast at EPI. It's the State of Working America podcast. Make sure and follow that. It's a great watch and a great listen. And be sure and stay tuned to all of our podcasts right here at realinvestmentadvice.com. And we'll bring you up to date on all of our new information, new contacts, new interviews. It's all coming your way right here at realinvestmentadvice.com. Thanks for joining us. We'll see you next time on the next Real Investment Show podcast. I'm your host, Lance Roberts. Baby.